Hi, my name is Jim and I was retired. In this video, I'm going to combine a few topics that I've been thinking about this week. I'll show you how they are interrelated. I had been planning to talk about the latest inflation numbers released this week and what the Fed might do about them next week. But then I got a question from a follower on Twitter asking about where to keep money you're going to need in the short term. It turns out I hadn't addressed that topic directly, and it really does depend on the state of the economy. So I'll cover both topics in this video, where to stash the cash and where not. Stay tuned. If you follow this channel, you know that I use a 3-bucket strategy to manage my DIY retirement. I keep about 3 years of expenses in cash and equivalents. And the second bucket is income-producing assets for the next 5 years. And then the third bucket holds long-term assets that I do not need to touch for at least 9 years. I did a video on what's in each bucket that you can check out. But let's review where I stash cash. 1 year of cash is in the bank, and that's a taxable account. But not all of the next 2 years is in a taxable account. Some of it's in tax deferred, and it's in CDs, I-bonds, and T-bills. I don't go for the highest interest. Instead, I keep assets in safe places where I can access them as I need them. The goal is not to chase yield, but to think about minimizing risk and reduce the cost of holding cash. Now keep in mind that even that CD at the bank that's earning 4 or 5% interest is losing money. The real interest rate, adjusted for inflation, is still negative. And keeping money under a mattress at 0% is losing at about the rate of inflation, which you can see here. It's running about 6% as of the February Consumer Price Index reading. Now, we won't get the Fed's preferred PCE measure until the end of this month, but the most recent reading in January was 5.4%. So unless your CD is earning more than that, you're simply trying to reduce the cost of keeping your cash available for when you need it. So safety is the driving reason for stashing cash in bucket 1. Now, I keep about a month's worth of expenses on average in my checking account, and the rest in savings accounts. The one that's associated with the checking account, a premium savings account at my bank, and another online savings account with Marcus. Now, I know Marcus is currently paying 3.75%, and that's not the best rate. There's higher than that, but it's the one that I've automated. And I know after working with it for about a year now that I can move money in about a day. I've also tested recently redeeming an I-bond as part of my I-bond strategy for 2023. And I moved money from Treasury Direct into my bank in about 3 days. The CDs and the I-bonds and the T-bills that I purchase keep the money stacked up and safe for when I expect to need it. Now, I manage interest rate and duration risk. Right now, I see no reason to go out to like a 5-year CD, for instance. Keep it short and safe, and I'll walk into longer CDs as rates make sense. As you keep money in banks, be sure to understand the FDIC insurance limits. Now, I'm not going to go into details here. Rob Berger and Devin Carroll both put out 2 great YouTubes this week that explain the details, and I'll link to them in my notes. But generally, $250,000 per individual and account title at a given bank. That means that a married couple could have 2 individual accounts in each spouse's name and a joint account in both of their names. And they've put away $750,000 in insured deposits at the bank. Now, if you need to keep that much cash close at hand, know the rules. Now, CDs count, whether at their local bank or brokered CDs. And I like to use broker CDs for a lot of my CDs because each is protected by the same FDIC insurance. And you can spread that out among different banks so that you never approach the limits. Now, I like brokered CDs because they are automatically redeemed. There's no need to take a CD paperwork to the local bank to redeem it. I only buy new issues. Click that on your choices as you search for CDs with your outfit. I don't use brokered secondhand CDs, and it's market priced. And I'd rather know what I'm paying for a CD, what principal I expect to get when it matures, and how much interest I'm going to earn. Now, I still hope the Fed will stick to its guns and raise rates for at least 2 more meetings so that the Fed funds rate will finally be above where we expect the PCE inflation rate to be. And if we do a 25 basis points in March and 25 basis points in May, we will barely be there. If we pause in one of these meetings, we may miss the boat. Keep in mind that when those rates go up, you're likely to see CDs and savings rates at banks go up a little bit more too. Now, as my CDs and T-bills mature, I can move them up into those next rates. Now, of course, the market really doesn't seem to know what to expect from the FOMC next week. In the wake of the Silicon Valley Bank and the Signature Bank failures and the latest CPI numbers, the CME Fed Watch tool has been all over the place. The last reading from today is for a 70% chance of a 1/4 point increase next week and then hold there in May, with rate cuts as soon as June. And again, if that happens, we may miss the chance of putting inflation under control again. Now, where not to stash cash? Well, if you get a massive infusion of cash and don't know what to do with it, don't do what Silicon Valley Bank did. They took the massive influx of uninsured deposits in 2021 and invested it in long-term treasuries and mortgage-backed securities. They forgot about interest rate and duration risks. They should have kept some of their cash in short-term treasuries and managed their books to ensure they had liquidity. Now, we'll end up paying for that mistake with FDIC surcharges on our banks, which, regardless of what they say, we'll end up paying for that. Now, keep in mind that the Federal Reserve is there as the lender of last resort, and the discount window is there for a bank that has that liquidity need. And that seemed to be the proper avenue for resolving these issues. But somehow we got an extension of the FDIC to all deposits of those 2 privileged banks, but now we have the moral hazard and the expectation that the next bank that runs into trouble will get the same protection. I think we've just opened a can of worms. Hey, please like and subscribe to this channel if you like entertaining ideas from a DIY retiree. And add a comment below about how you are stashing cash. I will conclude with my standard warning. I am not an economist or a financial planner. I have no initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one.